Hi, my name is Ishan Parvez, and I'm going to be talking to you about financial management and an introduction to investing. So, during this webinar, what I want to cover is three main topics. One, tips for financial responsibility. Two, using credit cards effectively. And three, an introduction to investing. Now, this is targeted at graduate students, young professionals, and or undergraduate students as well. But it's not just limited to that demographic. It could be for anyone. If you take these tips and apply them, they should help you out with your financial responsibility. So let's get started. Now, let's talk about tips for financial responsibility. The first thing you want to do is be able to effectively budget your expenses. Creating a budget allows you to not only allocate funding to what you need to spend, but also allows you to save effectively. So the first thing you want to do is create a budget that takes into three pieces of information into account. One, you want to be able to pay off your immediate obligations, such as rent or bills. Not paying them will lead to direct adverse responses. So that's stuff you want to get off right away. Now, the second thing is you want to start paying off high cost debt, i.e. credit cards or loans which accrue interest over time. High cost debt is basically any type of debt that you cannot offset by investments or so forth of that specific debt that you have taken. For example, credit card loans or credit card debt is usually a high cost debt because your annual interest rate could be like 13%. The annual stock market interest rate is around, or appreciation is around 7%. There's no way you could offset that amount unless you had some good strategy to do so. So it's generally a good idea to pay the stuff off before interest accrues and you start adding more cost to what you've taken out as a loan. Now, the last thing is you want to allocate funding for yourself and day-to-day spending. So, for example, if you want to go out, go get something to eat, budget for like food, groceries, entertainment, and so forth, you want to allocate those in your budget. Now, these three pieces you want to include in your expenses. Now, there's various software you can use for this, but what I personally use is either Mint or Truebill. They allow you to track your expenses in real time, which is beneficial. But we'll talk about that more in detail on the next few slides. Now, secondly, you want to create a budget for savings. This is something that a lot of people don't do and graduate students don't exactly kind of put away for. Even though you're not making a significant amount, it's good to develop these habits early because when you are, you can reference back to these habits. So I break that savings down into two categories. One, liquid short-term savings, which you have on hand right away. Those are usually your 3 months out expenses that you can pay for if you have an emergency. And then you also have long-term savings as well, which means something like an investment or kind of making use of your money and getting a return on that money. And we'll talk about why you should do that as well. So let's talk about the budget for expenses. I talked about high cost debt already. Basically, you can't offset it. Student loans and credit card are usually high cost debt, and you want to start paying them off as soon as possible so interest doesn't accrue and just take over your entire savings and everything. Now, always live within your means and never go over budget. When you create a budget, follow it and try not to deviate from that. Now, there are tactics and ways that we're going to discuss on how you can do this. But one thing that I find to be very interesting and very useful is using a software to actually be able to track your expenses. Truebill on one hand and Mint on the other are both very good software. One costs about $3 a month and the other is free. Intuit Mint is free. But Truebill actually tracks your subscriptions, expenses, and so forth. So I actually have a subscription to it just to monitor my expenses and track what subscriptions I have. As our economy or as our means of consumption move to more subscription-based products such as YouTube, Netflix, and so forth, it's easy to forget that you are spending money monthly on these expenses. So I use Truebill personally, but you can pick and choose whichever one you want for your personal means. Okay, so let's talk about savings. First, we'll talk about short-term savings. Those are savings that usually you want to liquidate within a year or have quick liquidity in the said asset. So basically, one perfect example is having 1 to 3 months of emergency expenses allocated or basically tucked away. You don't want to have quick access to these savings, but as quick access meaning you can just take your credit card or debit card and just blow through them. Basically, you want to make a conscious decision on, hey, I need this money and this is an emergency. So that is your short-term saving. Now, when I say keep the money away from your checking or credit account where you have quick access to, it allows you to basically decrease its availability. By decreasing its availability, you can now basically live within your means and not reach into funding that you should not be reaching into. For example, if you were to have, let's say, a checking account and a debit card for that, and basically you had all your savings in that debit card, subconsciously you'd basically be like, hey, I have a lot of money and I can spend it on this and I can afford this, which you actually cannot. So basically moving that savings into a separate account which you do not have ready accessibility to will allow you to basically maintain these savings. Now, short-term savings, you want to be able to spend them within a year. What I personally do is I have 2 short-term savings accounts, one for trips or things that I want to buy within a year, and then another one for emergency purposes as well. And these are very liquid, meaning that I can readily just convert them over by basically calling my bank account or basically going online and just clicking over. But I cannot access them via credit card or debit card. Now, long-term savings is where anything greater than a year. Now, this is very important. Long-term savings, you should probably throw that money on the market or have some means of investment to start making money for that money. There's a time value to money, and that can appreciate over time and build wealth. Now, if you have your money in a long-term savings account that does not have a return on investment, then what's eventually happening is you're losing buying power of your money because the average inflation rate is about 3.22% per year. So your buying power is going down by just having it in a regular savings account. So if you're not going to spend it for within a year, then why even have it in a regular savings account? Put it on the market or put it on some sort of investment return vehicle where you can get some money back and kind of compensate for this average rate of inflation. So let's talk about liquidity of assets. This is very important because as you move into investments and basically putting money into other sources, you can reduce the liquidity of it. A highly liquid asset is something that can be readily turned to currency on hand. So something like cash in your savings account that can basically be converted over without it losing any value right away. And you don't have to like liquidate it or have to wait for a certain time for it to reach a certain price or something like that. So those are highly liquid assets, basically cash on hand. Now, a moderately liquid asset is something that you can basically convert very quickly if needed, but it sometimes is a balance between, hey, should I convert it now or should I convert it a little bit down the road? A perfect example is a stock. If you were to convert about, let's say 60 days ago, you've been at the bottom of a trough or bottom of somewhat of a COVID-19 recession. Not the best time to liquidate your assets, but in an emergency, that's what you got to do, and you can basically get your funding back within a week of liquidating the said asset. Now, a very non-liquid asset is something that will take a significant amount of time to liquidate, and you need to find a buyer and so forth. So, for example, like a car, you want to get a good price on it, you want to sell it for a certain amount. then you have to find buyers, you have to basically vet them, and you have to basically transfer documentation for it. It'll be a very long process, but you will be able to get your funding within maybe a month or two based on how desperate you are for the funding. So these are just basic examples of degrees of liquidity. So now you can adjust the availability of some liquid assets, and you're not really changing the liquidity of the assets, you're just changing the availability. This was what I was talking about short-term savings. A good strategy for short-term savings is to keep it separate from your checking account, that you have readily accessibility through a credit card or checking card or a checking account, card, that you can basically start pulling money right away. By doing this, one, you separate your savings from your readily usable expenditure funding, and two, you don't create that subconscious idea that I have more money than I actually do. By separating this and operating on a lower amount, you basically signal to yourself, oh my God, I don't have as much funding in my account, I should really control my spending. So if you have less in your account readily available to you, that means you'll have to think about what you're spending money on. You can't go out and buy a PS5 out the gate, so what you're going to have to do is, hey, I'm going to make the active investment in that, so I will liquidate part of my ready savings account. So for example, if I was to do that, I'd have one savings account that is for this specifically, which I use in case I want to purchase something that is outside of my usual budget. So decreasing your ready availability actually goes a long way, and that's a good tactic to use to stay within budget. So now let's talk about credit cards. Credit cards have a negative association with them through various means, and there are horror stories out there where people have just put everything on credit and have screwed themselves over. So let's talk about the pros and cons of credit cards. Now, the pros to a credit card is, one, you have more buying power on hand. You have the ability to build your credit score, which is huge later down the road. And three, it gives you return on expenditures, meaning you get cash back or points or some various perk which will attract you to a specific credit card company. And that is really important when talking about credit cards. You get all these pros for that. Now the cons, of course, it accrues interest after payment periods. It's usually high interest rates, so it's a high cost debt. Usually, even with my credit score, I get interest rates from 13% to 20-something%. But if you're not going past that accrual date, you don't pay the interest. You just pay off the credit card in the month, and you won't accrue that amount of interest, which is a good strategy for sure. And of course, this is the horror story. You can fall into a cycle of overspending and then accruing interest charges and then just trying to play catch up the entire time, which is a position you do not want to be in because, one, screws your credit score, and two, now you're playing catch up with where you'll have to probably jump into your savings account to liquidate. So, tips for credit cards. Always have one active. It's crucial that you have this. Ideally, have one with your oldest line of credit because your credit score is usually tied into that. I have one from about 10 years ago that I still use readily, and that's been affecting my credit score and actually causing it to rise. And one thing about your credit score is if you don't have a line of credit, you don't develop that, especially early in, because you're not probably not taking out car loans and so forth because you don't have as much funding for that or income for that. So you want to have something like this to start building your credit. One thing that's bad about your credit score is if you don't have any credit history or any line of credit, that's as bad as having a low credit score. You're not going to get approved for any significant loans unless you have a cosigner. So always have one, and usually just keep the oldest one on hand. 2, use credit cards to manage and track your expenditures. They're a perfect way of keeping a good eye on your expenditures because you're not going to be carrying cash or like coins or something like that. You basically swipe and it'll update on your statement. And that will allow you to track that. And it will also allow software that you deem necessary, for example, Truebill or Mint, to track it as well. So it's a very good idea to have this to track your expenses as well. Now, 3, always try to use credit cards for purchases if possible. This is very important. Most vendors have to pay a fee to Amex, MasterCard, Visa, whatever, for their perks. There's an additional expense that they just incorporate into what you're buying, regardless of if you're paying for it through credit or not. So you are paying for these additional perks that Visa allocates, so why not use them? This is why I have a credit card that has cash back, 1.5%, and I just collect it at the end of a month or whenever it exceeds a certain amount. Now, depending on what you value, if you value travel and so forth, you might want a credit card that is geared towards that, and there are many out there. So I would do some research and find one that works for you and just get approved. 4, never buy anything you do not have money on hand for or cannot liquidate right away before the interest accrues. So this is really important because if you buy something that you cannot afford and you don't have the money on hand for it, you will start accruing interest and find yourself in a downward spiral, which is the horror story of credit cards. So always have the money for what you take out for credit. That's why I like to keep my credit card within my banking account, so I can just basically look at my checking account and then look at my credit account and say, hey, yes, I have more money in my checking account than my credit, so I can pay it off before the interest accrues. And finally, of course, always pay off before the interest accrues, and you will never have to run into that problem. Now, with that, if you pay it off before the interest accrues, and let's say you have a 1.5% back credit line, you will collect 1.5% after you pay it off. So you're basically making 1.5% for all the expenditures that you pay off, which is a very good deal. So now let's get to investing. This is a very, very shallow dive into investing. It is not an end-all thing, and there are various means of investments. There are various forms, and it can get really, really difficult very quickly, or it can get very convoluted very quickly because there are actually degree programs for this specifically. So let's just do a shallow dive. Let's talk about what you can invest in, investment vehicles. So you have mutual funds, index funds, stocks, and bonds. Now this is just talking about investments as far as the stock market goes. There are other investment vehicles. You can invest in real estate, invest in a house, or so forth, and it gets a lot more convoluted. But let's just talk about the stock market, something that you most likely will have funds for investing in. Usually, if you want to buy a house, you have to have at least a 6-figure down payment and so forth. So we're not going to talk about that. So let's talk about the difference between a mutual fund, index fund, stocks, and bonds. A mutual fund is basically a pool of money that is collected through basically a various assortment of investors. And what that does is somebody, an actual person, takes that funding and allocates it to stocks within a certain grouping, meaning that mutual funds usually have targeted metrics that they try to meet. For example, if you have a mutual fund within the tech sector, it will invest in tech stocks. For example, let's say a tech sector that targets virtual reality or something. It will invest in NVIDIA, AMD, and so forth, and create a certain distribution of that, but you will not be doing the investing. Someone else will be doing it for you. Mutual funds are a great way to basically throw money into a pot and just let it ride and have somebody actively invest for you, which works pretty well for diversifying your portfolio, which is huge. Don't just invest in one stock and have it try to appreciate over time. You open yourself up to a lot of risk like that. But also, it kind of gives you a more passive approach to it because we don't actively have the means to just keep investing every day and so forth and try to sell and buy. Someone else does it for you automatically. Now, one caveat to this is that these do have annual expenses through the brokerage account that you go through. So mutual funds are actively managed, meaning a person actively manages them. So they will have a higher percentage that they basically take from your account every single year. Now, this higher percentage, if you have exponential growth, you will have exponential growth in debt. So be wary that over the course of like 35 years for a retirement account, this could be 2% could be hundreds of thousands of dollars right out the gate. It's a sizable amount. Now, index funds are analogous to mutual funds. They basically take a pool of money and they invest it into various sectors. Now, index funds are actually basically stocks that are, they basically are treated as stocks. So those stocks actually have allocations within different companies and basically distribute the amount similar to mutual funds, but they are not actively managed by people. It's basically a fund that tries to match the market, which has its merits because basically it has a lower annual expense. You don't have an actual person doing the investing, and it just tracks the markets passively. So you are getting good dispersal of your investment, and you're not basically investing in one single asset. So, but it is not actively managed. Now, this actually is one of the more popular options because the expense ratio is very, very low. You get good representation of the entire market, and you basically can get the same return without having to pay a high annual expense. There's something called the efficient market theory, which basically says that any investment gain will be offset by investment loss over the long term and will adhere to the curve of the market. So if your active investor is going to basically gain money today, lose money tomorrow, and just level out anyways, why not just invest in an index fund? Because now you're not trying to beat the market, you're just trying to match it, which is going to be the outcome for a long-term investment anyways. Index funds is what I personally invest in, and I moved over from purely mutual funds to just purely index funds and stocks. So moving to stocks, this is what index funds and mutual funds invest in. They're basically investments in specific companies. For example, you have a stock in AT&T, you have a stock in NVIDIA, you have a stock in GM, and so forth. You can invest in these companies individually. Now, these things do fluctuate rapidly based off the market and how volatile it is. Right now is an interesting time to invest because you can get a 1%, 2% increase or a 2% loss in a day. And based on how much you have, that could be a sizable amount, relatively speaking. Now, with these, you don't have any annual expense, but do note that some brokerage accounts actually have a expense charge for any external entities that you buy. So for example, Vanguard, my personal brokerage account, charges me $7 per trade. So just be aware of that. If you are trading in this and you do have a fee like that, then just be cognizant of it and incorporate that into your decision on investing into a stock. Finally, the last one is bonds. Basically, you're purchasing debt from various entities. It can be government, it can be corporate, and so forth. But basically, you purchase this debt, and they pay you back a certain amount every month until they pay off that debt to you. And now, these things do not fluctuate as much or as violently as stocks, and usually provide some sort of anchorage or volatility reduction in your portfolio. So it is very important to kind of not just invest in straight stocks, but have some something that kind of anchors you down, but still gives you return on investment. And the allocation changes as you age and as you kind of take various considerations into account to basically build your portfolio. Speaking of portfolio, actually, we'll go to that next. Let's talk about the investment pathway. Very simple investment pathway. The one on the left is your personal bank account. Then what you're going to have to do is get a brokerage account such as Vanguard, Charles Schwab, Robinhood, or so forth, intermediary that actually puts your money on the market. So when you're basically money from your bank account goes to a money market account or something account that is controlled by or a fund that is controlled by one of these entities, that whichever one you pick. Personally, I have Vanguard. Then from there, you can allocate that money however you want. You can throw it into stocks, you can throw it into mutual funds, you can throw it in bonds, and you can throw it to ETFs. Basically, that's the pathway to investing. Very simple. Don't just throw your money into the brokerage account, into the fund there, because it's usually a money market fund, which will not be accruing that much interest or dividend payment and so forth. You want to throw it on the market, which this is the pathway to do so. So let's talk about portfolio allocation. This is very, very important. As you can see from this graph over here, you have very different portfolio percentages. Basically, you have a percentage of stocks, bonds, and cash. Now, a conservative portfolio, 40% stocks, 50% bonds, 10% cash. This is good for someone who is older, who has a sizable amount of income or a sizable amount of money already in the stocks. So you kind of start converting to bonds. So now you get paid every month, and you don't get as much volatility because you cannot handle large volatility, especially at older age, because now you could lose a sizable amount of income. Or not income, but a sizable amount of your retirement and so forth. A moderate portfolio, 50% stocks, 40% bonds, 10% cash. Yeah, that's a little bit in the middle. And let's say aggressive portfolio, 70%, 25-5. Now, this is not the only way to kind of do allocations. There are more aggressive portfolios. I actually have a progressive portfolio because I have a certain amount of time that I have it invested. I have certain tolerance for risk based on my age, and I have a certain amount in there. So all those things considered, what I personally have in my investment account is 88% stocks, 10% bonds, and 2% in cash allocations, because I like to keep my money on the market and I don't need to have as much cash on the market, because I have two different savings accounts that I have separate to this actual portfolio. Now, in contrast to that, my retirement account, I have 90% stocks and 10% bonds with zero cash. Because I'm taking that out in about 35, 40 years, I don't need to have any of the cash on hand because I don't need to liquidate it. Plus, it's in a retirement account, so I will get penalized for money that I take out. So 90-10 is what I have over there. And that's going to adjust as I age over time. And basically, my risk my risk factor gets adjusted, risk tolerance gets adjusted for that. This is something I would do research on and basically understand before actually starting to invest. You want to have a certain portfolio allocation that gives you maximum return and limits your risk on the market. If you can maximize your return and minimize your risk, you have a winning portfolio. And this is something you can either do yourself by looking through websites like Investopedia and so forth, or you can actually talk to an advisor, a financial advisor, who will do this for you, but they will charge a sizable fee. So it's good to learn all this stuff yourself so you can do it for the future. So last thing, I just want to talk about why you want to invest long-term savings. There are tangible benefits and there are intangible benefits that most people do not see. So tangible benefits, 1, you build wealth over time. 2, you're not letting your money lose value as inflation in a static account through inflation. And 3, you can get quick returns on investment based on how you manage your account. You can actively manage it, meaning you buy and sell within a day, day trading and so forth. Not my cup of tea, but there are people that do it, and there are people that make a good amount of money off of it. But as with investing, if you can make a lot of money, you can also lose a lot of money. So just be aware of all of that when going into it. I passively trade, and I don't really like to fall into that. active trading craze. So intangible benefits. One, you're building emotional maturity when it comes to investing. This is huge because when you gain money, you have an emotional response to it. You're like, hey, I'm going to invest more. When you lose money, it's like, oh my God, I have to pull out. But as you gain emotional maturity based off experience on the market, you will know when to pull out and when to actually just let it ride. For example, this COVID-19 cycle, when everything crashed, the market's going to come back. It pretty much is within spitting distance of where it was before. And basically, I invested at the bottom. I was like, hey, rather than pull out, I'm just going to invest, because if I pulled out, I would have been on the downward slope and I would have lost money. So now it's back up 30%. So I invested in cycles at the bottom so I could basically get maximum exposure at the bottom of that trough. Where the market goes now, who knows? But building emotional maturity is huge, because when you have a small amount of money to lose and invest, you can develop this emotional maturity and not lose a lot relative to what you could be making later down the road. If you don't develop this and then you go into investing afterwards, you could literally end up losing thousands or hundreds of thousands of dollars on poor investing strategies and just not having the emotional maturity to be on the market. So in that case, you probably need somebody to invest for you. Now, the last thing, or secondly, you want to basically develop an understanding of the market and how it operates. By doing this, you can now manage your own accounts, manage your own retirement, and understand where the money is going, rather than have some little black box thing where you throw money into and it throws on the market. If you have a better understanding of this, you will know how much your return is and what you can do to kind of adjust that return. So that's why this is extremely important to develop this now. And finally, being able to manage your own money rather than pay someone else to do it. I'd rather know how to be financially savvy myself than to have someone else do it for me, because they can take a sizable cut of your income for that. So these are the tangible benefits and intangible benefits, and why to get into investing even if you have a small amount to invest. Good idea off the bat. Of course, you can lose money, but what you lose, you gain in experience over time. Well, that's the end of my webinar. I thank you for your time and thank you for listening.